When you hear that an AI predicts stock prices, forecasts markets, or estimates future economic trends, it can feel almost magical. Numbers go in, predictions come out, and suddenly people trust these forecasts with real money. But behind every AI-generated financial forecast is not magic, and it's not certainty. It's math, data, probability, and limitations. In this video, we're going behind the scenes. We're breaking down how AI actually generates financial forecasts, what data it uses, how machine learning models work, why predictions sometimes fail spectacularly, and the ethical questions no one talks about. This isn't a hype video, it's a reality check. Because understanding how AI forecasts are made is the difference between using AI intelligently and blindly trusting it. Before AI ever entered finance, forecasting already existed. Analysts used historical data, economic indicators, company fundamentals, and assumptions to estimate future outcomes. These forecasts were never guarantees. They were probabilities dressed up as confidence. AI doesn't change this core truth. It changes how probabilities are calculated. A financial forecast is not a promise of what will happen. It's an estimate of what is most likely to happen if certain patterns continue. AI simply processes more patterns, faster, and at a larger scale than humans. AI forecasts are only as good as the data they consume. In finance, this data comes from many sources: historical prices, trading volume, volatility measures, macroeconomic indicators, earnings reports, interest rates, inflation data, and sometimes alternative data like news, sentiment, or social media. AI does not understand markets the way humans do. It understands numbers and relationships. It looks for repeated behaviors, correlations, and sequences over time. If the data is incomplete, biased, or outdated, the forecast will reflect those flaws. AI doesn't correct bad data, it amplifies it. This is why data quality matters more than model complexity. At the heart of AI forecasting are machine learning models. These models are trained by feeding them historical data and asking them to identify patterns that preceded certain outcomes. The model doesn't know what a recession is. It knows that certain combinations of indicators often came before market downturns. It doesn't know what investor fear feels like. It knows that volatility spikes and liquidity drops often occur together. Over time, the model adjusts its internal parameters to reduce prediction errors. This process is called training. The goal isn't perfection, it's minimizing mistakes on average. AI learns by being wrong thousands of times, faster than any human analyst could. Not all AI models work the same way. Some focus on regression, estimating numerical outcomes like price ranges or returns. Others focus on classification, estimating probabilities such as whether markets will rise or fall. More advanced systems use neural networks that attempt to capture nonlinear relationships, patterns too complex for traditional models. Some models specialize in short-term signals, others in long-term trends. The key point is this: no single model knows the market. Each model captures a narrow slice of reality. One of the most dangerous aspects of AI forecasts is how confident they appear. Clean charts, precise numbers, and probability percentages create an illusion of certainty. But behind the scenes, every forecast includes uncertainty. AI outputs probabilities, not truths. When people treat these outputs as guarantees, they misunderstand the tool. AI doesn't say, "This will happen." It says, based on past data, this outcome appears more likely. That difference matters, especially when real money is involved. Most AI forecasting systems are validated using backtesting. This means testing the model on historical data to see how well it would have performed. Backtesting is useful, but it's also dangerous. Markets change, relationships break. Strategies that worked before may fail in new conditions. AI can look brilliant on past data and fail miserably in real time. This is called overfitting, when a model learns history too well and reality too poorly. Smart forecasting systems constantly retrain and adapt. Even then, failure is inevitable. Markets are not physical systems. They are social systems. Humans react to predictions, news, fear, and greed. When AI forecasts become popular, they can change the very behavior they are trying to predict. This creates feedback loops. If many traders act on the same AI signals, price movements accelerate or reverse unexpectedly. In finance, prediction changes reality. That's what makes forecasting uniquely difficult. AI is excellent at identifying patterns in stable environments. It struggles during regime changes, wars, pandemics, policy shifts, or black swan events. AI cannot predict surprises by definition. It can only extrapolate from known data. When the world changes suddenly, AI reacts. It doesn't foresee. This is why no AI forecast should ever be used alone. It must be combined with risk management, diversification, and human judgment. As AI forecasting becomes widespread, ethical concerns grow. Who is responsible when an AI-driven system causes massive losses? Who audits the models? Who controls the data? There's also the issue of unequal access. Institutions with better data and faster systems gain advantages. Retail investors often rely on simplified tools without understanding their limits. AI doesn't create inequality, but it can magnify it. Transparency, education, and accountability matter more than ever. AI itself doesn't manipulate markets, but it can be used to do so. Automated systems can trigger stop losses, exploit liquidity gaps, and amplify volatility. This raises regulatory challenges. Policing algorithms is harder than policing people. As AI grows more autonomous, these questions become more urgent. The future of financial regulation will have to evolve alongside AI. For investors, AI forecasts are tools, not truths. They are decision aids, not decision makers. The smartest users treat AI outputs as one input among many. Understanding how forecasts are generated helps investors question them intelligently instead of accepting them blindly. AI doesn't replace thinking, it demands better thinking. AI forecasting represents a shift from intuition-based finance to probability-based finance. This makes markets faster, more analytical, and less forgiving. But it also makes them more transparent for those who understand the systems. The future of finance won't belong to those who predict perfectly. It will belong to those who manage uncertainty best. AI forecasts are not crystal balls. They are mirrors of the past projected into the future. They are powerful, imperfect, and misunderstood. If you know how they work, they can sharpen your decisions. If you don't, they can mislead you with confidence. AI doesn't remove risk from finance. It reveals who understands it. If this video helped you understand what's really behind AI financial forecasts, like the video. It helps push deeper, smarter content into the algorithm. Subscribe if you want honest breakdowns of AI, finance, and investing without hype or false promises. Comment below. Do you trust AI forecasts more, less, or the same after understanding how they work? And share this video with anyone who thinks AI predictions are guaranteed. This might change how they see them. The future of finance isn't prediction, it's probability, and now you know how it's built.